Hey, it's Similolu here, and in this video, I'm going over a very important candlestick pattern called the DOJI. To be a successful trader, you've got to understand charts. The charts are always speaking. Being able to identify candlestick patterns helps you understand what the charts are saying. Is it a good time to enter into a trade? Is it the right time to exit from a trade? Without this important information, then it's almost impossible to trade profitably. We're going to start off by understanding what a doji is, how it works, and how it can help make you a more profitable trader. So without further ado, let's get right into it. A doji occurs when open and close prices are almost exactly the same. There are different variations of the doji pattern. We have the common doji, the long-legged doji, the gravestone doji, and the dragonfly doji. The vertical line of the doji is called the wick, the topmost part representing the highest price and the bottommost part representing the lowest price. The body of the candlestick represents the difference between the opening and the closing price. Now, this will vary in height depending on how close the closing price is to the open price. A doji is formed when buyers enter into the market and push prices up. Sellers step in to sell, which then results in prices falling back down again. In other words, price action does not favor either direction. It is this up and down movement that forms the wick. The body is formed when price closes at more or less the same level as the open price. So now we've gone over some of the basics of what a doji is and how it is formed. Let's get into some real life charts and see how being able to identify our dojis will better inform our trading. A doji represents indecision in the market and serves as a signal for reversal in a market that is either upward or downward trending. A bullish doji would appear at the end of a downtrending market, and it would signify the onset of a reversal in trend leading to an increase in price action. A bearish doji, on the other hand, would show up at the top of an uptrending market, indicating an impending reversal leading to a drop in price action. A dragonfly doji is so named because its shape is similar to that of a dragonfly. It can be found at the bottom of a downtrending market and is characterized by a long lower wick. This dragonfly doji that has appeared at the bottom of this trend started off going all the way down to the yellow line of support before reversing and heading back up, hence that long bottom wick. This reverses the trend, moving price action further up. A gravestone doji is so named because it resembles a gravestone. and is characterized by a long upper wick. Price opens at the bottom of the candlestick. It runs up, gets rejected at the top of the candlestick, and comes back down to close again at the same price level at which it opened. The presence of this gravestone doji on a chart would indicate an imminent reversal and would be followed by falling prices. If you were in a trade at this point, then of course it would be a good idea to get out of the trade. And for a short seller, it would be a point at which to enter into a short trade. Looking at this on a live chart, first we have the upward trend in motion. Then we see a gravestone doji forming at the top of the uptrend, followed by a decrease in price action. With a long-legged doji, price action opens and closes at the same point, but within the time frame of the candlestick, price runs up and then runs down and still manages to close at the same point at which it opens. For me, this shows a high level of indecision and volatility. I will basically wait on the next couple of candlesticks to determine whether or not to enter into this trade. Looking on the live charts, as soon as a long-legged doji has been identified, because it shows both a high level of indecision and volatility, I wouldn't enter into the trade either way until the next couple of candles confirm the trend. A particular note of caution would be to not just use the presence of any candlestick pattern as the green light to enter or exit a trade. It's usually a good idea that it be used at strong support and resistance levels or trend lines, which would serve to confirm the candlestick pattern. So this chart is on tradingview.com. And looking at the candlesticks, we can see this doji. Now, sometimes it's easy to identify a doji, but also it can be beneficial to have an indicator switched on such that every time a doji pattern forms, we actually get a flag. Now you can set this up by clicking on the function tab here, type in doji, and it comes up with the different types of dojis. So we're going to just click on the doji, we're going to just click on the bearish doji and the bullish. And going back to our charts, we can see the indicator is switched on. So identifying a doji is now made easier simply by using the built-in doji indicators. Now this particular doji shows up at the end of a downtrend, and the fact that the bottom wick is longer than the top wick indicates a dragonfly doji. The next move is for price action to trend upwards. Each of these candlesticks is 15 minutes, so we actually have 45 minutes of upward trend, which is more than enough time to enter and exit a trade with profits. Well, that's all, folks. I hope you've gained some key information from this video. And if you have, don't forget to hit that like button, share with your friends and family. Don't forget to comment below, subscribe to my channel, but most importantly, don't forget to hit that notification bell. That way you get my video as soon as I upload it. And I'll meet you in the next video.